Hey everyone, welcome back to the Weekend Charts. Charlie Bilello here. Big show for you as always. A lot to discuss. We're going to run through the stock market and the rebound, the bond market, bond yields falling. We're going to be talking about the FOMC meeting. We're going to be talking about the jobs report and so much more. So stick around to the end. As always, if you like the content, subscribe to the channel and let's begin talking about that stock market rally. And the bulls are fighting back here. The market's bouncing back. And I'd say there's two primary reasons for the short-term advance this week, where the stock market was up every single day this week. Number one was sentiment. We talked about this last week, but I want to talk about it again because it really hit an extreme here. We're looking at the AAII sentiment poll. So this is looking at weekly data in terms of polling investors. Are you bullish, bearish, or neutral on the market going forward? And hit a 50% level in its most recent reading, which is the 96th percentile. So it was the percentage of bears was higher than 96% of other readings. That's pretty extreme, pretty negative. You don't often see that. And what you tend to see looking forward is a bounce back when you tend to see this extreme negativity, extreme fear in the marketplace. Number two would have to be the interest rate move that we saw here. So a lot of fear when the 10-year Treasury yield hit 5%. Investors concerned inflation might be coming back. You have these debt levels. You have a lot of concern that higher interest rates are going to lead to a slowdown in the economy. So when we got this relief here with interest rates falling this week, equities moving higher, I think, as a result of that as well. So 5% down to around 4.5%, pretty sizable move in terms of the 10-year yield. You don't often see a move that big in a short period of time like this. So looking at that chart of the S&P 500, you can see here so far V-shaped recovery. It was below the 200-day moving average and quickly recovered and closed well above it at the end of the week. And strong rally pretty much every day this week. So 5 straight days of advances for that S&P 500 index. And if we look at volatility, probably no surprise, but it was absolutely crushed. It was a little bit elevated above 20, not anything extreme by any means, but quickly moved lower. Is actually 30% lower on the week, the VIX, and that's a rare thing to see. You don't tend to see volatility go down that much in a single week. So big difference in terms of sentiment, in terms of volatility from week to week. A lot more optimism, obviously, today than a week ago. But if we look at the S&P 500 this year and we look at the VIX and look at volatility, as I've said, this is pretty normal year. It's kind of the average in terms of the VIX. We're around 17.5, the average VIX level so far in 2023, and that puts you right in the middle. So as an equity market investor, this is a pretty standard year. 2022, we've talked about, was above average in terms of volatility, definitely above average in terms of drawdown. But this year so far, we still have 2 months to go, but a very normal year in terms of volatility. I want to talk about investing during a drawdown because this is something that all investors have to confront, because most of the time the stock market is in a drawdown. More than often than not, it's not at an all-time high. You're below that level, and investors have to deal with this each and every year because there's a drawdown of some magnitude. Now, this year, 10%, not huge. The average year is around 16%, median year 13%. So relatively mild year, but still it's troubling when you're in the midst of it. Investors naturally feel like the market's going to keep going down. It's going to be lower a year from now, a few years from now, because the news is typically bad when you have these types of drawdowns. But what does the data suggest? If we look back at history at different levels of drawdown, is there anything an investor can kind of say about the future if you're at an all-time high versus, let's say, down a few percent or down 10 to 20, 20 to 40, or more than 40%? And the answer, unfortunately, is pretty much no. There's nothing to be gleaned in the data except for the fact that the market is usually higher a year from that drawdown, 3 years, 5 years, 10 years, and the longer the time period, the higher the probability that the market is going to be positive and you're going to have a good experience as an investor. So there's nothing to suggest that just because you're in a drawdown, you should be expecting the market to be lower a year from now. It's actually the opposite. You should expect it to be higher, but as is always the case, nothing is 100%, particularly in the short run. there definitely have been times where the market's been in a drawdown like this and has been gone down more over the next year. So 78% of the time market's positive. That means 22% of the time when we're in a drawdown like we were last week, the market's lower a year later. If we lengthen that out to 3 years, it's only 9% of the time lower. 5 years, 5%, 10 years. When you get to 10 years, you're at 100% in terms of percentage positive, at least historically. So, big lesson for investors. You have to be thinking long term. The longer your horizon, the bigger the cumulative returns are on average. And that's where the big money is for investors. But you really shouldn't fear a drawdown. You should embrace it, especially if you're adding to your accounts every paycheck. Because you're able to buy in at lower prices and you tend to have higher prospective returns, so higher future long-term returns, the bigger the drawdown. So if you're looking out 15 to 20 years, you're in your 20s, you're in your 30s, you have at least 20 years in terms of before you're going to start withdrawing. The best thing that could happen is to have a big drawdown where you're now buying in, averaging in at lower prices. Let's talk about earnings again and the bottom line. And once again, I want to emphasize the earnings so far have been pretty good, better than expected, up 19% in terms of year over year. Now we have 64% of companies reported. So more reporting every day. By next week, we're probably going to be up to around 80%. So we'll give another update then. But 19% year over year, third straight positive quarter. Pretty good in terms of overall earnings. If we're looking at GAAP earnings or operating earnings, both moving up. And we actually have GAAP earnings now less than 2% off of their record high from the end of 2021, from the fourth quarter of 2021. We had that earnings recession last year, but a big comeback this year. And that's driven not only by continued top line growth, but by very good bottom line growth, where you had just that enormous cost cutting, particularly in big tech. And that's reaping the benefits this year in terms of the bottom line. Now, Apple reported this week, and unlike the other big tech companies, Apple's still showing a negative year-over-year revenue growth number. Once again, barely negative, almost 1% in terms of the year-over-year decline. But important to note, the stock did go down a little bit on the news, but important to note that net income for Apple, like the other big tech companies, much better than a year ago, up 11%, 23 billion in quarterly net income. So I think investors, obviously the reason why it wasn't hit more, investors are starting to look forward in terms of Apple having a recovery in terms of its revenue, and they just continue on the bottom line to improve. So if we're looking at operating profit margins, I added Apple to this list that I created last week. Across the board, you're seeing margin expansion in terms of this quarter versus a quarter, same quarter in 2022. So Apple's margins, 28%, moving up to 30% over the past year. And you can see all of these companies showing improved profit margins over the last year. And if we're looking at the big picture in terms of major companies here reporting, you can see top line growth pretty strong across the board. A number of these hitting a record high in terms of revenues for the quarter. You can see Apple at the bottom of this list, S&P 500 overall around 5% in terms of revenue growth. And so pretty good top line, but the big story has been the bottom line in terms of all of that cost cutting, the operating leverage, and you're just seeing huge net income gains from AMD, Amazon, Facebook or Meta, Google, Microsoft, Netflix, all higher than the S&P 500's earnings growth, which is pretty good at 19%. Then we have Apple over here and Tesla, really the only major company to the downside. And we've talked about what the reasons are for Tesla. It's that huge cost cutting, price cutting in terms of the vehicles, where you're seeing 30% or more in terms of the average vehicle price. Lower today than it was a year ago. So hitting the margins of Tesla, but the other companies moving the other direction, higher profit margins. So overall, this is probably part of the story as well. With a lack of bad news in terms of the inflation picture, and in terms of the Fed, which we'll talk about, and in terms of bond yields moving higher, investors obviously coming back to earnings as a reason to be positive. So definitely part of that 6% advance as well is this earnings recovery, and less than 2% again below record high in terms of S&P 500 earnings. So let's shift gears, talk about the labor market. Another report showing a real loosening of the labor market. So this has been a long process, but month after month, we continue to show a loosening of that labor market. And now we have 34 consecutive months of jobs growth. So 150,000 jobs were added in October. Not a huge number, a little bit below expectations, but in terms of the overall picture, still moving in the right direction, still adding jobs. And what are some signs that showing the labor market is loosening? If we look instead of the monthly number, which is very noisy, look at that year over year number, 1.9% growth now. That's the lowest growth rate since March 2021. So, yes, we're still adding jobs, but just at a slower pace in terms of a year over year growth rate. If we look at hourly earnings as a big one, moved down to 4.1%, which is the lowest since June 2021. So, lower wage growth, and that's a function of just there's fewer positions available. There's less of a supply in terms of the labor available. So you have the situation where employers are not pushed as much to increase wages. The exception being the labor deals that we've talked about last week in terms of the UAW, that being the exception to the rule. For the most part, you're seeing wages come down this year versus last year. And another point in terms of loosening labor market, if we look at the quits rate, so people feeling less comfortable quitting their job is a sign that the job market is loosening a bit here as well. Down to 2.3%. And if we look at the ratio between job openings to the number of unemployed people, that has moved down as well, down to 1.5. Still elevated for sure, but moving down very, very slowly here. And I suspect this will continue. We should see as the months go on, we should see the number of job openings come down, and we should see this ratio continue to normalize, and probably going to see that wage growth number come below 4% in the next month or two. So let's talk about the unemployment rate here. Interesting part of the report, ticked up a little bit, 3.9%. That was the highest number we've seen since January 2022. So a little bit of time since we've seen unemployment rate that high. And now, importantly, it's moved up around 0.5% from that low. So 3.4% was the low in April 2023. And now we're up 0.5% off of that low. And historically, let's say this is the cycle low, 3.4%. So assuming that's the cycle low, historically, what has happened off of these other cycle lows historically when you've gone up half a percentage points from that low? So in this cycle here, 3.8 moving to 4.3%, this 4.4 moving to 4.9%, and so on. What has happened in the past? Well, interesting. I put together this table here illustrating different economic expansions, right? Different unemployment rate lows for each of these. But when you have that 0.5 percentage point move off of the low, you tend to have a recession start relatively soon thereafter. And if we look at, let's say, the last 5 or 6 recessions, it's usually within a month or two of that happening. And so today the question is, well, is that going to be the same? Are we going to see a recession start in the next few months? Who knows? Maybe this will play out again. Maybe it won't, but it's certainly a sign of, it certainly has been an indicator in the past of something. Now, if we go all the way back to October 1945 to November 1948 expansion, where we had the same unemployment rate low of 3.4%, there was actually a longer lag. It took 9 months before the recession began from that 0.5 percentage point increase off of the low. So perhaps it'll be a similar thing, but the people who are saying that there won't be a recession, and we talked about, you can't say that just yet, and the Fed's rate hikes that they've done are just starting to really influence the economy, and we'll talk about that in the Fed portion. But this is an interesting thing to watch. We'll see if the unemployment rate continues to move higher here. We'll see if this is once again an indicator of future economic weakness to come. A lot of people dismissing this, but interesting, it seems to have a pretty long track record. It makes sense, obviously, intuitively. As a recession is beginning, the unemployment rate is moving higher. That's part of of the that's part of the calculation in terms of, are we in a recession, is that the unemployment rate is moving higher and job growth is slowing, or you're going to start to see job losses at some point. And the question this time is it different in that we had such a dislocation in terms of the jobs market during COVID? Is it different this time? Has that changed things? And that's certainly a possibility, can't be dismissed. And as we talked about, if we look at that the job openings chart and we look at other data that we have, it doesn't seem like, let's say next month or the month after, it doesn't seem like jobs growth is over just yet, because that hasn't normalized yet. So perhaps it's going to take longer this time around, but this will be something that I'll be watching closely, something interesting to watch. So let's move on, talk about the FOMC meeting. And we have this situation where the Fed is expected now to pause, and then cut interest rates. And why is the market expecting that? Well, I think it was a combination of what happened in terms of the data this week and kind of the signals that the Fed gave. And if we look at what the Fed did this week, it was absolutely what the market expected it to do. So every time before the Fed meeting, I do this tomorrow's news today. And once again, the market was expecting the Fed to hold interest rates. And once again, the Fed indeed did just that. And if you go back to 2009, as I've said, the Fed, every single meeting has done what the market has expected it to do heading into that meeting. There hasn't been one deviation where, let's say, the market was pricing in a hike and the Fed cut, or the market was pricing in a cut and the Fed hiked, or the market was pricing in the Fed doing nothing and they did something. Every single meeting, the market was expecting something, the Fed did exactly that. So the streak there continues. But if we look at the important thing in terms of the messaging from the Fed, Powell is saying still that same thing. The Fed has a long way to go on its fight against inflation. So even though they're pausing interest rates, they don't want to give any indication that there's going to be a cut anytime soon. And they're saying they're going to have to keep monetary policy restrictive in order to get inflation down to 2%. Now, that said, there was a huge shift this week in terms of what the market is expecting for that December meeting. So whatever he said or didn't say, the market is now pretty much in the camp of saying there's no way the Fed is going to hike rates in that December meeting. And that would go against what the Fed was projecting just back in September, where they were saying we're going to hike a few more times this year. And that doesn't seem like it's going to happen now. If we look at the Fed funds futures here, 95% probability that the Fed is just going to hold rates at that December meeting. Now, this could change, but a huge increase in terms of the probability of holding. It was just 53% a month ago. Now it's 95%. And last month, there was actually a 7% chance that people were saying the Fed was going to push rates all the way up to 5.75 to 6% by the end of this year. Now they're saying 0% chance and only a 5% chance of another rate hike this year. So big shift in terms of expectations. But in terms of rate cuts, Powell made it clear that they're not thinking about it. They're not talking about it. Nothing is being considered. But the market really doesn't seem to believe Powell once again. And this has been a consistent theme this year that we've talked about a number of times, where the market has expected rate cuts, and Powell said, no, we're not going to do it. And then the market had to adjust. So we'll see if this is going to be another one of those situations, because here we are in November and the market's saying pause, next 3 meetings, but we get to May of 2024 and the market's saying the Fed's going to cut. Now that's moved up from June. So before the FOMC meeting, before the recent employment data, the market was expecting that first cut to occur in June. Now they're saying May. So they've moved that up. So big shift in terms of expectations. And again, we'll see what happens over the next few months. I think if the Fed obviously is going to cut in May, given their history, they're going to start telegraphing that well in advance. So we're not there quite yet. There's a lot of data and a lot that can change between now and then, but interesting to see that the market is expecting a rate cutting cycle to start as early as May of next year. And then at that point, they're not just saying one and done. They're saying the Fed's going to continue to cut rates and bring them down to 4% by November of 2025. And this curve is going to change significantly over the next few years. It's almost certainly going to be wrong. The question is, how much is it going to be wrong and what direction? But still, it's important to note that what the market is expecting here, the market's saying the Fed, they could talk the talk as much as they want, but they're not going to keep interest rates higher for very much longer, maybe 6 more months, and that's it in terms of keeping interest rates at current levels. So if we look at that comparison that I often show between the Fed funds rate and core PCE, Fed funds rate is expected to stay flat. Core PCE, according to the Fed, according to market expectations, should continue to come down. We look at the housing component, that should drive that lower. And so I think, yes, the market is saying, well, they're going to be restrictive here for the next 6 months, but then this is going to come down enough where the Fed can start cutting rates. And perhaps coming back to that recession talk in terms of the unemployment rate, perhaps by May of next year, unemployment and the employment market is going to be in a much different place, where the Fed then is concerned about economic weakness, and that'll be an additional reason for the Fed to cut rates. So a lot's going to change between now and then, so don't give it too much of a focus. But for now, the Fed's sticking to the case that they're going to continue to keep the monetary policy in restrictive territory, going to continue their quantitative tightening and letting the balance sheet roll off. And they're going to do that, they're saying, until they're confident that inflation is going to move down to 2%. And clearly, we're not there just yet. So let's talk about the bond market and 60-40, which a lot of people are saying is dead now. They've been saying that for a number of years. We'll get into that. But where are we in terms of the bond market and in terms of the longest bear market in history? Well, now we're 39 months into it, and you can see here that there's nothing even close to it. This is going back to the inception of the Bloomberg Ag Bond Index in 1976. We're at 39 months, started in August 2020, and a bigger drawdown than we've ever seen in terms of the bond market. And the reason for this, I'll say it again, it definitely bears mentioning. The reason why we had the longest bear market in history is that yields started at all-time lows, and they rose from those lows. And when you have no cushion from the starting point, no cushion in terms of your coupon, it's going to lead to enormous losses when you have this type of interest rate rise, with the 10-year bond yield going from 30 basis points to 5%. So let's take a look at the last 7 years in terms of the 60-40. You can see bonds here in the red contributing nothing to a 60-40 portfolio over the last 7 years. Is that normal? No, absolutely not. You can see back when bond yields were high, bonds contributed a whole lot to it, and it's just been a declining contribution for the last 40 years as bond yields have come down. And of course, over the last few years, given that huge interest rate rise, we've seen that erase all of the returns for bonds over the last 7 years. Now, what is this picture going to look like going forward? Well, let's first start with the bond side. It should look better over the next 7 years. You got bond yields, we talked about it, at 5% today. Much different picture. 7 years ago, you were looking at 1.5%. So much better returns projected for the bond market of that. So that 40 should be a positive contributor over the next 7 years. How much, that remains to be seen. Direction of interest rates will dictate some of that, but most of that is going to be dictated just by the starting yields today, which are in a much better place. Now, the stock market, as you can see here, much more difficult game to play, much more difficult game in terms of trying to predict what the stock market's going to do, even over a 7-year period. You can see enormous returns during the 1990s boom, enormous returns during the boom after the lows in 2009. And you could see periods where, and this seems crazy for investors because it's been so long since this has happened, but periods where you had a 7-year return that was negative for the U.S. equity market. And could that happen again? Of course it could. If it happened before, it could definitely happen again. So if we look at that 60-40 portfolio over the last 7 years, 5.4%, and all of that and more is coming just from the stock side, bonds being a net detractor. So over the next 7 years, bonds should be better. We don't know about the stock market. Obviously, given the volatility of stocks and given the higher weighting in the 60-40, the stock market is often a much bigger driver of that overall return. And that should be the case again going forward. And we'll just have to wait and see. Of course, historically, stocks have done around 10% a year, but huge fluctuations during, as you can see here, the annualized returns during 7-year periods. It's very rarely at that 10% level. It could be well above that, it could be well below that, very rarely right at that average. So, just an interesting thing to watch here in terms of bonds. Never really having a 7-year period where they've been down, but we never had a situation where interest rates were so low. And so the future going to be much better for bonds. For stocks, almost impossible to predict. But in terms of the 60-40 being dead, well, that at this point, saying it's dead is saying that the stock market's going to be dead, because if you didn't say 60-40 was dead 7 years ago when bond yields were extremely low, then you shouldn't be saying it today. So let's talk about mortgage industry and huge decline, probably not unexpected, but I want to touch on that quickly here. Looking at 30-year fixed rates, of course, highest since November 2000. We had just an absolute collapse in terms of the purchase index, purchase applications, lowest since 1995. So just a lack of mortgage activity, and no surprise that mortgage industry employees are going down and going down pretty fast. 20% decline off of their peak levels so far. The expectation is this is likely to continue. Back after the last housing bubble, you saw a 49% decline in terms of the number of employees in this industry from 2006 to 2012. So it can take a long time before the industry readjusts. If we look at the average pay for loan officers, it's been cut in half over the past few years. And big reason for that, of course, is that they're not closing on loans. You have 3.5 loans average officer last month versus 8 in the same period in 2020. So not unexpected, but you're seeing the natural decline that you would expect after a huge boom period that we saw for a number of years for the housing market, and then particularly when you had interest rates falling to record lows and you had huge refinance and you had activity and you had people purchasing more homes, and now the opposite situation. Now, if we talk about the housing market again, the most perplexing thing is that prices in terms of residential real estate are hitting new all-time highs here. This is the Case-Shiller index. At the same time, affordability is at record lows. And the reason why this is happening, as we said, is not because there's a lot of demand for housing. Demand has absolutely collapsed. Activity has collapsed. It's because supply has collapsed even more. So I wouldn't expect this to be off to the races here and another boom. The question is, do we go sideways for a number of years, or do we come down as reality kind of meets the market, and we just see that supply start to slowly come back to the market? And if we look at the 20 city index here, you can see up 2.2% overall over the last year, but really mixed in terms of some locations are down, some cities are up. And overall, my big point would be, don't expect the gains that we saw in the last 5 years from the housing market. The next 5 years, if we look at this chart 5 years from now, you're going to see much, much different numbers in terms of this city index. And that's simply because incomes have to catch up to it. Ultimately, housing has to be affordable based on your incomes. And it's absolutely not today. So whether that means prices coming down or income slowly catching up, that this chart is going to look very different a few years from now than it looks today. So I want to end, as I always do, with something positive, and that's in the rental market. So very different than the housing market, where we're seeing prices continue to go up and affordability go down. The rental market affordability slowly improving here. And just a quick picture in terms of where we're coming from 2019 to 2022, we saw this enormous increase in the price of rent, and rents really exceeded people's incomes by a wide margin. We had over half the US renters spending greater than 30% of their income in rent. And that was the highest that we saw in over a decade. And we saw an increase of 1.9 million households that rent, an increase in terms of the percentage of them that were cost burdened. So spending more than 30% of their income on that monthly rent. So the good news, rent is moderating here, actually down 1% in terms of the average asking price for monthly rents. That's another year-over-year decline. Not seeing a huge decline after this huge run up, but we'll take it in terms of people's incomes are going up slowly, and at least rents are not going up. They're actually down off of their peak. And if we look at this chart of absolute value in terms of the average asking price, it peaked in 2022 at $13.87 per month, and we're at $13.54. There's seasonality to the rental market, so we should see rents actually go lower over the next few months as well. And the good news is supply, unlike the housing market, is actually increasing, and we're seeing increasing vacancy rates. So that's going to put additional pressure in terms of landlords not raising rents and perhaps even cutting rents in terms of new rental offerings. So if we're looking at the national vacancy rate, 6.4%, that's up from a low of 3.9% in October 2021. So much better picture, kind of more of a normal number. And so we could see rents continuing to decline going forward. And with incomes going up, we're talking about incomes up 4.1% over the last year in terms of wages, rents lower. Well, that's making the rental market more affordable for the average household. So other areas in terms of the inflation picture that is good news, definitely have to talk about gas prices. Unexpected here, move lower. We had talked in September about a positive shift to year over year in terms of rental. Gas prices were actually higher than they were over the prior year. But now for the month of October, we've seen a sharp move lower. That's continued into November and now lower than where they were a year ago. So this is going to be helpful, I think, in terms of October CPI when we get that report. And indeed, the Cleveland Fed is actually saying that it's going to drop back down to around 3.3%. So very good number there from where we were last month. And hopefully this is going to lead to a continued decline in CPI, and this will cross back below 3% instead of above 4%, which many people were fearing after the recent rise in CPI. So talking about inflation, talking about wages, what's the most important chart to me? Well, it's this chart showing real average hourly earnings. So comparing wage growth over the last year to inflation, and for a number of months, and this is why people are feeling so pessimistic, their wages were not keeping pace with rising prices. And we've had 5 straight months where that situation has been different, where wages are outpacing prices. And I expect when we get that next CPI report, it's going to be a 6th consecutive month. Again, we have that 4.1% wage growth over the last year. And if CPI comes in around 3.3%, that spread is positive. So people are going to be feeling better, much better about that. And hopefully this trend continues. So with that, we'll leave it right there. Have a great weekend, everyone. Thanks for joining me today. If you like the content, as always, subscribe to the channel, and I'll see you next time on the Week in Charts.